Before we start the video, please take some time to read through the important notes and disclaimer. Do note that investments always involve risk and the possibility of losses, and past performance is no guarantee of future performance. Any reference to prediction, projection, forecast on the economy, stock market, bond market, or the economic trends of the markets or past performance is not necessarily indicative of and is no guarantee to the future or likely performance of your investments.
Hi everyone, my name is Angie. I'm a wealth manager at Auto Wealth. I have my Chief Investment Officer, Taichi, with me today. Let us walk you through the Future 2050 portfolio. Taichi, over to you.
Thanks, Angie. I'm excited to introduce to you the Future 2050 portfolio, which aims to capitalize on the macro trends of technology changing the world and healthcare resolving the aging population needs. All Auto Wealth Plus portfolios are specially curated by the investment team to reflect a particular macro theme or investment strategy that aims to deliver above market returns. Our portfolio curation process can be simplified into 3 simple steps. First, extensive qualitative and quantitative analysis is carried out to determine the sectors that will make up the portfolio. The ETF weightage is then carefully constructed to replicate and track the MSCI All Country World Index. Our team then screen over 10,000 ETFs listed globally and select the best ETFs possible for your portfolio based on various factors such as diversification and risk-adjusted returns, etc. The process doesn't stop here. In fact, our portfolios are reviewed regularly to ensure the underlying ETFs in your portfolio are consistently the best ETFs possible and the allocation weightage is relatively consistent with the index. Now, Angie will share more with you why you should be investing in these sectors.
Thanks, Taichi. Okay, now let's take a look at the chart on the left. Basically, it shows a breakdown of the annual sector performance of the S&P 500 over the past 15 years. It is clear that over the last 10 years, technology and healthcare have emerged as the top 3 performing sectors, outperforming the S&P 500, delivering a return of 398% and 230% respectively. So these 2 sectors' strong performance over the past few years was supported by solid fundamentals, and we believe that these sectors are well positioned to deliver favorable returns to investors in the long run. Let's now dive deeper and explain why we should invest in these sectors. Okay, first, let's take a look at the IT industry. Technology has become increasingly integrated into business processes and consumer behavior. As companies recognize the importance of investing in technology, worldwide IT spending is projected to reach 4.5 trillion in 2022, an increase of 3% from 2021. The 2 fastest growing categories of technology spending in 2022 are software and IT services. Okay, the rise in software and IT services spending has been accelerated by the pandemic. The pandemic has led the transition of a hybrid workplace, and this drives the growth of cloud adoption, which is likely to continue to boom in the upcoming years. Technology new trends such as AI and cloud computing have caused several digital disruptions across industries, and this blurred industry boundaries. According to McKinsey 2022 Technology Outlook Report, it is found that most of the industry sectors display a meaningful association with 5 or more technology trends. For example, most industries from banking to transportation have adopted AI technology. This shows that the possibilities of technology is limitless and can be found in every industry. Today, we observe that the technology sector has dominated the equities market with 7 out of 10 top companies being tech-related. Such companies include Microsoft, Apple, and Amazon. Next, let's take a look at the healthcare sector. Healthcare sector is expected to boom with increasing life expectancy in the US, leading to an increase in demand for long-term care services and health consumption. Healthcare spending accounts for nearly 1/5 of the US economy and is nearly double relative to comparable countries as shown in the graph. Riding on the rising demand for healthcare, the following three niche areas of healthcare, medical devices, healthcare service providers, and biotech industries are likely to grow considerably. With multiple virus variants and a growing preference for home testing, we can observe an upward trend in the demand for medical devices, such as the COVID-19 test kits. Leading manufacturers such as Thermo Fisher Scientific and Abbott Laboratories' revenue has been increasing as a result of the pandemic. Next, let's take a look at the healthcare provider sector. Our healthcare providers portfolio segment is diversified into a few of the largest US insurance providers. Given the large amount of spending in the private insurance market, it justifies our decision to do so. For instance, United Health Group, which holds the largest share in the portfolio allocation towards healthcare providers, is expected to experience high growth arising from the increasing demand for healthcare services required to support aging population. The expansion of pharmacies also proves that there is a strong growth opportunity for such healthcare services provider sectors. The revenue of pharmacies in the US have been increasing as a result of the pandemic and aging population, with CVS Health leading the growth with close to 10,000 retail locations, accounting for 36% of the industry's total revenue in 2021. Lastly, let's take a look at the biotech sector. The growth in biotech is supported by increasing prevalence of chronic and infectious disease. The percentage of people with 2 or more chronic illnesses is also projected to increase steadily, and 90% of the nation's healthcare expenditure is on chronic and mental health. So, with more unknown and new diseases emerging, biotech is needed for vaccines to be produced quickly and effectively. To meet this rising demand for vaccines, regulatory requirements were also streamlined to make production more efficient, which accelerates the growth of biotech industry. For instance, a standard vaccine development takes up to 15 years to be approved. In contrast, the Pfizer vaccine only took about 10 months to be developed and approved for emergency use authorization, even though it consists of the same phase as the typical vaccine development. Overall, healthcare spending is imminent and cannot be delayed, supporting the growth in this sector for decades to come. One great news over here is that healthcare and biotech funds are currently sold at a discounted price as compared to the broad markets. Reason being, there is a stronger market interest in the energy sector due to the Russian-Ukraine war and rising inflation. So, this is actually a very good opportunity to have some holdings in these sectors with the below market price and promising outlook. Lastly, why do we allocate 10% to a minimum volatility ETF, in this case USMV, in our portfolio? The minimum volatility ETF seeks to track the index composed of emerging market equities that exhibit low volatility characteristics, which helps to provide downside protection for your portfolio. As seen from the left chart, minimum volatility has a track record of delivering market-like returns with less risk, as they have historically lost less during market declines, while still manage to capture meaningful gains during upswing. During market volatility, USMV is observed to lose only 67% of the total loss accumulated by the benchmark. This is again proven during the COVID sell-off period, where S&P 500 recorded a negative 12.35% loss, while USMV only recorded a slightly lower loss of 11.93%. All investments involve risk, and here are some key risks we should be aware of. The IT sector faces inflationary risk, while rising inflation leads to higher costs and is likely to dampen industry profitability and access to capital. However, over the longer run, tech companies are well positioned to deliver strong performance by leveraging on powerful themes such as AI and cloud computing. High inflation also led to Fed raising benchmark interest rates aggressively and hence adversely affect the valuation of tech stocks with substantial future earnings. But tech stocks will likely rebound once the Fed moderates or pauses its aggressive monetary tightening. Technology companies also faces more government regulatory risk, even though the window to pass significant antitrust reform is rapidly closing. The healthcare industry also faces key risks such as regulatory reform and clinical trial risk. However, a longer investment horizon and diversifying across different healthcare sectors might help to mitigate such risk. Moving on, Taichi will share more about the potential risk and returns.
So, what are the risk and performance numbers like? And how does it perform when compared to a reference benchmark? Let's look at the returns first. While the portfolio has performed in line with the MSCI All Country World Index and slightly underperformed the MSCI USA Index in the recent 1 year due to the tech crackdowns in China, the portfolio has significantly outperformed the market benchmarks over a longer run basis of 3 and 5 years. The Future 2050 portfolio achieved a 5-year annualized returns of 18.54%, while the All Country World Index and the USA Index achieved an annualized returns of 8.79% and 14.02% respectively. From a risk perspective, the portfolio's annualized volatility of 19.13% is also significantly lower than the reference benchmark. On the maximum temporary drawdown, an indication of downside risk, the portfolio also performed better with a drawdown of 28.84%. Overall, if we look at the Sharpe ratio, the portfolio has a Sharpe ratio of 0.90, while the MSCI All Country World Index and the USA Index has a Sharpe ratio of 0.33 and 0.42 respectively. This implies the Future 2050 portfolio is able to provide higher assessed returns relative to the risk taken as compared to the reference benchmark. As mentioned in our introductory video, the Auto Wealth Plus portfolios are made up of 100% equity and tends to be more volatile than our Auto Wealth Starter offering. So, who should invest in the Future 2050 portfolio? This portfolio is ideal for investors who believe in the multi-decade themes of technology changing our world and healthcare resolving the aging population needs. Also, as these sectors can be volatile, an investor should have a longer time horizon of at least 5 to 10 years with a high risk tolerance to withstand potential losses that may arise from time to time from market volatility. If you wish to start a Future 2050 portfolio, all you need to do is to follow 3 simple steps. First, head over to our website and click Get Started. Next, you create the Auto Wealth Plus portfolio by clicking on the Plus tab and follow the instructions to fill in your financial goals, information, and risk assessment. Lastly, pick the preferred Auto Wealth Plus portfolio and fund your account. Thank you for watching till the very end. If you have any queries, please do visit our website or drop us an email to client services. Help us to improve our next video by scanning the QR code. And do look out for our next few videos as we will deep dive into other Auto Wealth Plus portfolios. Stay tuned. See you there.